Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
When I met you in the summer.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to the Equity Mates Summer Series. This is a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, then a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm good, Bryce. Very excited for this episode. Very excited for this series. You know me, I'm always excited for what we're producing here at Equity Mates. But it's hard not to be excited because over the course of this series, we're going to be speaking to 12 of the best advisors and investors and financial professionals here in Australia. We want to unpack the lessons learned from a lifetime of investing and understand how they would invest today, all to set us up for a great 2025.
That's it. And today we are welcoming to Equity Mates a veteran, a legend of the funds management industry, Ben Griffiths, who has been investing in the industry for over 3 decades now.
He's the co-founder, executive chairman, and senior portfolio manager of Eley Griffiths. He co-founded Eley Griffiths in 2002 with Ben Eley. But here's the thing. The small cap index has delivered 4.96% per annum since 2002.
Yeah.
Not great.
Not great, yeah.
Something we often speak about on the podcast is perhaps the small cap index not being the best.
Yeah.
But Eley Griffiths has almost doubled the index over that time, delivering 9.12% per annum over the past 20 years.
Yes.
Now, this conversation's great. Like, obviously, we speak about Ben's investing philosophy, how he approaches small caps. But I think for me, some of the bigger takeaways were around how he approaches investing for his family.
Yep.
He's got kids, and he speaks about how he's been trying to teach his kids the principles of investing. And whilst neither of us have kids, it's certainly a question we're getting more and more in the Equity Mates community.
Yes.
How should I invest for kids? How should I teach my kids the value of money and the importance of investing? So I think there's some really great takeaways there.
Well, speaking of, he then goes a step further, Ren, and illustrates how he would set up a portfolio for the next 30 years, not only for his kids, but for us as retail investors. And this wasn't just couched in theory. He came with specific assets and asset allocations.
Yes.
So stick around if you want one of the best investors in the small cap space here in Australia, giving you the insight on how he would construct that portfolio.
And yes, that portfolio does include crypto and uranium.
Yes, so stick around for that. And speaking of portfolio construction and investments, we have one of the best in the business, Viola Private Wealth, supporting this series.
Viola Private Wealth specializes in bespoke financial strategies with expertise in managing alternative investments like private equity and real estate. As managers of over $2.5 billion in assets, they help individuals and families unlock the potential of illiquid assets, adding stability and growth to their portfolios while still holding high-quality, diverse portfolios of equities.
Trusted by members of the Equity Mates community, Viola Private Wealth helps individuals grow and protect their wealth. So to find out more information, head to violaprivatewealth.com.au. We'll put a link in the show notes.
All right, well, with that, let's get to our conversation with Ben Griffiths.
Now, Ben, one of the things that we've learnt over the years is that investing is a journey that is never fully completed. No one becomes the expert, I guess. We're all striving to be perfect, but it's a journey that, as Buffett says, is lifelong. So with that in mind, what are you working on right now?
You've hit it on the head, Bryce. It is a journey. It's not a destination. Investing and being a successful investor takes time. You get better with time, and hopefully that shows itself in your performance and where your portfolio gets to or doesn't get to, as the case may be. We're busy at the moment, I suppose, in all fairness, is holding on to this bull market. Yes. And that's what we've got. We've got the Australian share market at all-time highs. We've got most Western developed share markets at all-time highs. So for us, what we're working most hard at is staying with that market and, if anything, trying to beat beat the market. So when times are buoyant and markets get a bit frothy, it's a challenge just to keep up. So we're doing that. We launched a new product last year called the Eley Griffiths Group Mid Cap Fund, and we're busily, certainly promoting that and talking a bit about that fund. But primarily our job is as investment professionals, and what keeps us awake at night, what's keeping us busy, is the next good idea and making sure that we're rewarding our unit holders handsomely, and that is very much a 7-day-a-week job. Trust me.
One thing that we're fascinated by when we speak to professional investors is how they both keep up to date with what's happening generally, but then really develop deep domain expertise in areas where the companies that they're investing in operate. And, before this interview, we had a look at your small caps fund and, some of the top positions at the time of recording, Breville in consumer discretionary, Pinnacle in financials, Fisher & Paykel Healthcare in healthcare, like very different businesses operating in very different markets. So what's your process and your team's process to really get your head around what's happening in these different parts of the market and developing the domain expertise you need to make investment decisions?
Sure. No, that's a fair question. Look, it starts, if you look at the daily basis, it's staying in touch with what's going on in the markets, both here and internationally, being across turnover in the markets, what stocks are moving to new highs, what stocks are moving to new lows, what stocks are trading with outsized traded volumes on a given day versus what they would traditionally trade at on a 20-day average, for instance. So you're looking at the market internals, we call it. So that's a day-to-day thing. Every morning I have got a checklist where I go through and I satisfy myself that I know exactly what's happened overnight and what that might mean locally. That the focus then pulls out to the stock level where we need to stay on top of the stocks. And to your point, we have a disparate list of portfolio members. And so that involves staying on top of their information flow, what they're doing, their results when they report them. It involves us going and seeing companies invariably. It involves us also speaking to brokers who cover many of the stocks that are in our portfolios. And there's this general broader reading on industry pieces. So we need to be on top of, in the case of Breville, we need to know what the consumer's up to. We need to know what their product development pipeline looks like. We want to know about how much they're spending on R&D, how they're going with their North American, European push, are the coffee machines selling or not selling. So you can be as busy as and engaged and go as deep as you need to make sure you're across it. But make no mistakes, there is a lot of work, and it starts with your daily analysis and it finishes really with supervising the portfolio on a monthly basis, making sure you can almost go through all 47 names in the portfolio and make sure I know why that stock was down 8% this month, or I know why this one's up 25%. There's a re-rating happening. And you can explain it. And as a portfolio manager, you've got to be able to know why each of your constituent holdings are up or down at any point in time.
Now, Ben, you're a veteran of funds management. You've been in the industry for decades. Take us back to the beginning. What got you interested in investing? What sparked the love of what you do?
Yeah, well, I would have been all of 15 years of age and I was a part-time milkman. I was obviously at school then, and I was a milkman. And I was also like a night filler. I used to fill shelves at a shop down at Bondi and used to go there and clean the shelves and stock the shelves, and got paid what was at the time was a reasonable amount of money, fairly modest probably in the scheme of things. But I worked several days a week and was a fastidious saver. And every dollar that I saved, I wanted to put into the stock market. My father had introduced me to the stock market, had mentioned the importance of owning BHP shares. So I had a token amount of BHP, but my interest spread very quickly. I was reading the financial papers and the share price listings, and I saw Ansett Transport Industries there, which of course was the airline and transport group. And I thought, I know that business. That looks like it's a thriving business. I should buy some. So I started putting every week's wage that I made, I'd set aside a little bit to go and buy a milkshake and something, and the rest of the money went into Ansett Transport Industries for about a year. Then I discovered an exciting resource company called Western Mining Holdings, Western Mining Corporation Holdings. And I thought, well, I'm a believer in nickel and gold. I understood what the gold price meant back then, so I bought some of those. Both those stocks ended up, in the case of Ansett, got taken out by T&T Transport Group. And in the case of Western Mining, eventually spun into Alumina and Western Mining, and then BHP took them, and Alcoa took the other one. And so I was able to generate great little returns there, and on the way through would get my annual report every year and my updates from the company. And I started to feel like I was not only making $1, which I was on my very modest shareholdings, making $1, but I found it fascinating. And I really enjoyed reading the annual report. I mean, I didn't understand a lot of it. I was only 15 or 16, but I knew enough to know the business was progressing. And so I was quite chuffed with myself that at age 16 or 17, I had a 3-stock portfolio. Most of my friends had never even heard of shares, didn't understand the importance of it. But my father always said, if you want to get ahead in this world, you need to become a collector of growth assets. You need to set a course that's not about buying a new car or going on a trip to Bali with your mates. You need to start saving. And so I guess it really was getting a great flavour and taste for stocks, and then getting a great return out of it. And then I was hooked. And from that point onwards, and I've done the same thing with my children, I've said we need to be collecting growth assets. So that's where it started. It was 15, 16-year-old, really enjoyed the hunt. And it is a hunt.
Yeah.
You know, like I look at Bryce's upbringing, and his dad and mum taught him about investing when he was young, and taught him to split his, pocket money into 3 buckets, one of them being investing, and like got him interested early. And, that's a hallmark of your story as well. And in our audience, we have so many people who are about to be parents or who are young parents and who are starting to think about how they teach, these money habits to their kids. But obviously, like, you're talking to a teenager who's probably not that interested in the stock market and compounding wealth over decades. They're thinking about, what they can buy today and, what else, other more exciting things for them. So how did you talk to your kids about it? What were some lessons that kind of got through to them and worked when you were speaking about it?
Well, I think the first thing is to identify with relatable businesses that they actually are aware of, and they can touch and feel. Lovisa, for instance, my daughters were well aware of the Lovisa chain. They even might have bought a bit of that jewellery in the stores. And I said, that company's publicly tradable, which means you can become an owner of that business. And if you're such a believer in the prospects of that business, maybe we think about buying some shares in Lovisa. No, we didn't end up doing that. We ended up buying some Cube Logistics, but that's another story.
Touch and feel business.
Touch and feel business, exactly right. The importance of moving boxes and ships in and out of the ports, and they sort of got it. But we did buy some Cobram olive oil, for instance, and the kids were fascinated that you could own a share in a business that not only grows the olives but bottles them, markets them, and in some cases exports them. And this is a business that's now developing an international presence. But the kids could quickly relate to it, so we bought some Cobram olive oil shares for them, which haven't done much, but I think the best is ahead. We'll see. And of course the kids bought some Commonwealth Bank, and the exciting thing about that is they can relate to that. And of course that has been one of the most extraordinarily strong performing stocks on the Australian market, let alone being a boring bank name. And the kids have kind of doubled their money on it. Their modest bet. So I think it was really familiarity in the first instance. That we picked companies that they could draw with a crayon, and Lovisa was one, and Commonwealth Bank's one, and Cobram. It's that sort of thing to get them hooked. And then I've got to say, the idea of a dividend arriving in your bank account twice a year, the kids looked at that and said, "What actually are these like vouchers, Dad?" And I said, "Well, I guess they kind of are like vouchers. They get cash twice a year, but they actually now get excited. They see the dividend check come in, and I think that's for me is." Part of that, in the nicest possible way, a bit of that dopamine shot hit that I want the kids to get, that hang on, I'm making a couple of dollars here and I'm saving, and I can see that this is a meaningful path. And so I just think the earlier you get on the journey, as my father said, the earlier you start collecting growth assets and have an appreciation for that, the better. And then down the track, we can talk about real estate when our incomes are right. We can talk about right now, the share market's a great place to get started. It's a great place to develop a holding in growth assets.
So Ben, from those that 15, 16, 17-year-old period of time, you experienced a couple of buyouts for the companies that you'd invested in. Are there any lessons from that time that you still kind of reflect back on to today?
For sure. I mean, there are early memories and early lessons learnt, and I look back at it and thought, it was amazing. Either by accident or design, I was buying quality back then. I was buying Western Mining Corporation. I was buying Ansett Transport Industries, and Dad had made me buy some BHP. I bought quality, and I didn't actually appreciate the time. It looked boring at the time, kind of. It turns out that quality looks after you. quality businesses, and I define quality as the management team and the caliber of the managers that sit astride the business model, the market, that company's presence within its actual industry that it operates is dominant, successful. They had pricing power. In the case of Ansett, they were part of a duopoly market structure. No matter that Ansett eventually went broke, but that wasn't during my period of holding it. I saw it as a successful duopoly. Transport group, well managed. The T&T obviously thought the same thing. So I think quality shone back then, especially through the lens of an old bloke. I look back and think I bought quality by accident or design, and it worked. Avoid the fast buck schemes. I was never drawn into speculative runs on might have been oil and gas stocks or gold stocks. I didn't actually know how to relate to that other than they're going up leaps and bounds. Wish I had some. I just didn't know what to buy, and I didn't understand them. So I think avoiding fast buck sort of excitable sort of boom bust type setups was something that I just didn't do thankfully I didn't do it because I would have been tripped up in that. And I think at the end of the day, I got started back then in becoming an avid reader. I maintained a level of investment curiosity. I remember I used to read the business section of the Sydney Morning Herald because that's what used to arrive at home, and that used to give me my fill. When I got a bit older, went to uni, I started reading the AFR, and then it was just like I was completely immersed in it. So it was keeping the reading up and keeping my level of curiosity fired. And then eventually someone says, "Oh, have you ever heard of a guy called Warren Buffett?" And I said, "Never heard of him." And I said, "I think you could do with doing a little bit of reading." And so I read Lowenstein's book on Buffett. Then I read Mary Buffett's Buffettology book. There began a journey for me on reading about the great masters, the great investment legends. I probably got on that in the mid-20s, started reading about Buffett and the like, and Joe Granville and those investors. And I thought, geez, I wish someone had told me about this when I was like 17. I would have started then because the lessons are extraordinary. So really, I think looking back at it, it was the happening upon quality names as an investment destination, just looks after you always. Avoiding the sort of, as I said, the fast buck, boom bust type stocks, which I did by accident again, but that looked after me. And then learning about being a provocative, curious thinker and doing the reading, and just know it. You to this day, I've always got a book on the market going, and I've always got a fun book as well going. Nice. I've always got, but I'm never far away. I just don't know. I'm a long way from knowing all that one needs to know.
Yeah. I think that curiosity piece is just something that we hear over and over again from the best investors that we speak to. It's just that is the fuel that drives so much of investing success. I'm
trying to get my children to develop that sense of curiosity. They are half curious about their stocks, their little portfolios, but I'm looking for it to be full blown where they start to embrace it. But
if you figure out the formula, come back on the podcast because I'm sure a lot of listeners will want to know what you did.
For sure.
But if we fast forward to today, Eley Griffiths has just celebrated their 20th anniversary. So a massive congratulations, and I'm sure you had a big party to celebrate.
Thanks, Ren. We did actually.
But over that time, have you developed, I guess, like an overarching investment philosophy that runs through all the different funds that you manage?
We sure have. Yeah. I mean, I'm fond of saying every investment manager needs momentum. You need a momentum tailwind, but you need a process, and you need to have a discipline by which you know when stocks are overvalued and you know when stocks are undervalued, and you know how to assemble a portfolio amongst the thousands of potential candidates, and you have a process. And we look at two elements to the process. One is, I talked about before, the qualitative feature, the qualitative factors, which are how good is management, how aligned are they, how experienced are they, how passionate are they. And then we want to look at industry structure. Are we investing into an industry that's well structured, disciplined, has pricing power, has a tendency to make profits rather than be subsidised and not be true? And that'd be half of our thinking, is that qualitative treatment. Make sure that you have the right management team and the right industry structure. And then, of course, there's the valuation piece, where we want to make sure that we deal in the world of PEs, PE ratios, which is how you price a stock, and then earnings per share growth outcomes. And what is the right PE multiple? What are you paying for that level of growth? And there's a trade-off there. There's a continuing trade-off every day. Is that stock too high for the growth it's promising, or is the growth too low for the PE that it's commanding? And so there's that trade-off. And now we have a process that looks at both disciplines. Your valuation work, and it arrives at an answer, and then the qualitative piece. which arrives at an answer. And the two are inexplicably linked. You don't go and build a portfolio based on the fact that you love the CEO, you get the valuations wrong or it's not right, and you don't go building a portfolio because it's the PE multiple's cheap, but it's run by a suboptimal team that's had high staff turnover, that's stuck in an industry that doesn't make money, that'll never make money, that's too fragmented and so on. So there's the convenient blending of the two, and it only works, it's the old garbage in, garbage out. It only works when you're surrounded with a team who've got experience, who are technically capable and savvy, who do their reading and are on top of what's going on. And so then it's so potent and powerful. You have a great process that works, and you have a team that knows it's only as good as the inputs. And so I think over 20 years, to your point, we've done 20 years. Not a lot of boutiques get to 20 years. They come off the road somewhere along the line, or they get taken over, or they don't get there. We've done it through hard work, but it's that investment process that's all important.
So you've had more than 20 years though in small caps, closer to 30.
Yep.
What fundamental principles of investing have remained constant over that period? Because the last 30 years, I mean, we've seen some extraordinary change in what is going on around us and across the markets as well. So what's that consistency that's remained?
Well, in the first instance, it's being true to process and having a process that if you're a value investor, which means you typically look for low PE stocks, you might only perform strongly in 2 years in 5. If you're a growth investor, which means you're going for stocks that have high profit growth year in, year out, then you might outperform 3 years in 5. The process we develop will allow you every chance, give you a really good shot at outperforming in 5 years out of 5, because we pick up on the elements of valuations and we pick up on the elements of growth. And that's what is affectionately referred to as a GARP investor, growth at a reasonable price. So I think in the first instance, we've built a process that is supposed to be, if run correctly, an all-weather investment process. So that's the first thing that we developed years ago. We want to give ourselves the best chance. Even with all of this, you can still stand on a landmine. Things happen unexpectedly, and you want to make sure that you're improving the odds that you'll be on the right side of things. We've also had a bias over the years to quality. We just seek out quality businesses. Even when we play in small caps and emerging companies / micro caps, we're not going right down to that very, very small end that people like to play in, that really tiny, the sub 100 million market capitalisation, where for us, the comfort factor is not so high. We're taking more of a punt that we're backing a team that we don't know much about, that no one knows much about, with a product that may or may not work. So we've tended to move up the other end of the scale, going for slightly larger small companies and slightly larger micro caps, where you're a better chance at finding quality. So you have process, you have quality, and the final thing that we do, and we do well, is we have experienced team members, and we've seen a bit in the market. It's one thing to be a great researcher and a great analyst, and that's important. You need to have market savviness. You need to have, we call it market mongrel. You need to have that market mongrel about you, where even though things looks cheap, you just know, your gut tells you it's actually going to get a lot cheaper. We should stand back. So I think it's that unique blending of process, quality, and an experience that means the market mongrel keeps you from doing dumb things. We don't get them all right. We can do a separate podcast on all the screw ups that we've made over 20 years. In fact, we'd need 2 podcasts, I suspect. But I think the balance of probabilities, if you've got all those elements working for you, is you're going to get ahead of the market, and you're going to be on winning trades in more cases than bad ones.
I want to drill down on this idea of quality, because I think it's something that can often be used by a lot of investors and can often be applied to. Maybe not incorrectly, but just like it can be broadly applied. So if you think about some of your most successful investments over the 20 years at Eley Griffiths, what were like some of the most common characteristics that you would see in like the the quality companies?
That's a very astute observation. Quality is a subjective thing. Your idea of quality perhaps might differ to mine.
Yeah.
And so quality comes in various forms. I know some of the more outstanding successes of our business have revolved around, in the first instance, quality expressing itself in the management team. I mean, Afterpay. I suspect a lot of managers that come on here talk about how they were early to Afterpay, and Afterpay was it. And we're going to be another one that says that we were on Afterpay early. But that was all about assessing quality from day one with Anthony Eisen and Nick Molnar. And we didn't know Nick so well, but we'd had experiences with Anthony Eisen in a previous corporate life. And if you can believe it, David Allingham, who works with our team, his father was an English teacher at Sydney Grammar School, and he taught Anthony Eisen. And I happened to have known at the time Sir Ron Briley, and we were able to very soon early in the Afterpay story work out that whether you think buy now, pay later, the way Afterpay doing it is going to work, and whether the government and the regulators are going to stamp it out and do whatever they thought they were going to be able to do, if you start with a basic step that you've got two very, very sensible, mature, focused and genuine operators, you're a long way ahead of everyone else who's just taking a guess. So David's father taught him. Sir Ron Briley said to me, of all the managers that he has worked with or worked near, there was no one got close to the calibre and the precision of Anthony Eisen. And then we watched their early steps and how they set forward with their model. So we had a lot of comfort on the quality of Afterpay. Much the same with car sales, which of course is a high-flying mid-cap today. We were there at IPO, and we very quickly, having met the principals around that business and met the CEO and CFO when it was coming to market to list, and it was listing on a very fulsome P ratio. It was not cheap, and it was very, very hyped and spruiked in the press. But we knew how the car sales model worked. They were the clear leader. It was a quality business in terms of their industry positioning. It was a quality business in terms of the founders that had formed and what they were trying to achieve. They weren't looking just to clear off the register and hand the puppy over to you. They were looking to bring car sales to market so they could prosecute their next growth leg. That for us was quality. I mean, there are two stories. I mean, Domino's Pizza we owned within a month or three of IPOing. We didn't buy it on IPO because I hadn't actually met Don May and his team. Within 3 or 4 months of IPO, I had met them, and I quickly realised, boy, oh boy, have we got a quality business here that's got a long runway. We've got a quality management team. We've got a business that's focused and determined to grow. And so each of those three are just three examples where you need to form an opinion on your view of quality, which often starts at the management piece, but equally it's the business model. It throws off lots of cash, right? With little assets employed, it'll generate lots of cash. There's a higher return on equity business in the case of each of those businesses, and that also is one definition of quality: high ROE. Some people look at free cash flow yield, how much free cash comes out of the business model, and the higher that number is, the better quality the business is. So it's a subjective thing.
Yeah.
Using Afterpay as the example, you're getting in on these businesses when they're small caps, and it obviously, we all know the story, ran incredibly hard. Did you hold it the whole way?
We did. Well, we stepped off a little early. But I say early, it had been a multi-bagger, as in it had gone up many, many times from what we paid for it. And as risk managers, as much as we're shooting for the upside, we've also got to be mindful of the downside. Every day we go into battle and manage portfolios. And so when a stock goes up 10, 15 times, it begins to eat the portfolio. It becomes such a big part of the portfolio, so we had to trim it a lot. So we weren't there at the end, but we were there for a fair way through its evolution, including the exciting move to the US. And that move, when they went to the US with Urban Outfitters, I remember David Allingham was on his Instagram following Urban Outfitters and just watching the reaction on Urban Outfitters. So the feedback from customers in the US saying, I don't know what this is, I'm broke and I can still buy my jeans and shoes. No. We saw that, well, this is actually going to work. Yeah. This is going to work in the US. If Urban Outfitters is anything to go by, I think this push is going to be a winner, which of course it turned out to be exactly that.
Yeah, it's an amazing story.
Ben, we're just going to quickly pause here to say a huge thank you to Viola Private Wealth for supporting this series. Illiquid investments offer unique opportunities for wealth creation. Viola Private Wealth integrates these assets into diversified portfolios, leveraging decades of investment expertise to ensure they align with your financial goals and risk profile. To find out more, head to violaprivatewealth.com.au.
So we want to turn to, I guess, how retail investors like Bryce and I can think about building a portfolio. And, we want to start with your area of expertise, which is small caps. So how should we be thinking about small caps as part of our retail investors' portfolio? And what's the best way to invest in them? And perhaps on the flip side, what are some ways that we should avoid investing in small caps?
You mentioned this before we came on air, and I've given it some time and I've thought about it, Ren. Small caps are the diversifiers in your portfolio. You might have your BHP and your Westpac and NABs. Small caps are the diversifiers that just introduce a little bit of risk, but also a little bit of upside that your traditional large cap stocks won't. So they're your diversifiers. They're also the nursery in your portfolio. These are the stocks that, if all things line up, they will be the 5, 10, 15 baggers, the stocks that will give you a great kicker. And they take years to come good, like car sales and Domino's, Afterpay. They take years to all of a sudden thrive. But they then become the nursery from which you sit back and go, what have I just created? And look at CSL and Cochlear. They were all once in the nursery, and today they are what they are. So small caps are the nursery. You've got to have them there for that reason. They're also the compounders. You get the right one, the right quality name, then they will give you multiple times returns, all things being equal. So they give you a compounding effect in the portfolio. And the final thing is to that point, they're the structural growers. They're the ones that are going to grow at like GDP plus outcomes, double-digit returns, whereas your banks and your BHP are much more modest. There's a ton of ways you can get exposure to investing in small caps and mid caps and the like. You can go to the market directly and chance your hand and buy some Breville and buy some Cube and buy some Lovisa. You can do that, but you need to have done the work. You can buy a listed ETF, a small cap ETF. And, of course, I would say this, you can buy a managed fund, which, of course, is the business we're in. And it's not just us. There are probably 45 different providers of small cap and large cap managed funds. But managed funds are a smart way of doing it because you get to our expertise. You get to cover a lot of ground, 47 stocks in the cases I mentioned before. You get to cover the market with us doing the worrying. We've got them 24/7, not you. You've got the exposure. And the history shows that the average small cap manager, who's described as the median manager, handsomely outperforms the Small Ordinaries benchmark. You have a look at a chart of the Small Ordinaries benchmark versus the ASX 100, go, who don't know those things? They look a bit sleepy. They never seem to do, once you introduce the manager, all of a sudden you see the substantial outperformance that the median manager, small cap manager, gives over smalls and over bigs as well. So that's another suggested way of getting exposure to the space. And as I said, there's a multitude of managers who have different approaches and different styles. And so we've got a certain style, which is probably slightly more conservative. There are others that dial up the risk. There are others that, are happy to short and happy to gear the funds, and that we're much more conventional than that. But there's a multitude of ways that you can get exposure there. But it needs to be, to my point before, it needs to be a part of your thinking.
Yes. Well, speaking of, Ben, we put the challenge to you before you came on to think about setting up a retail investor's portfolio for the next 30 years and how you would go about that without putting the money in your own fund.
Yes.
Because we find everyone just says that, which rightly so, fair enough. So how would you invest it, or at least and thinking about the principles that you'd use, where you'd be putting the money so that if you were to hand over a portfolio to someone for the next 30 years?
And I'd stress that I'm assuming with the answer to this question that you already have your accommodation or your real estate sorted. I'm not going to suggest you put half the portfolio in a Bondi apartment. No. You know what I mean? I mean, that's not going to happen. I'm assuming you've got that sorted. So This is your risk capital. This is your growth asset allocation. How are you doing it for 30 years? And I also thought to myself, maybe it's a 30-year lockup. You put the money in at age 20 and you can't get to this money, right, until you're 50. So you're kind of escrowed for 30 years.
Nice.
And so I did put some thought into this. I would, and I'll give you some allocations too. So I'll give you the category, and I'll give you the allocation. And this is, and I'll stress to all your listeners out there, this is theoretical. This is, I've been asked to answer this in a lock-up scenario. So the first important category I strongly believe is US industrial stocks or tech stocks, and I think 40% of this long-term portfolio should be invested in US industrial stocks, including tech. The next category, 20%, should go to Aussie mid-cap. Aussie mid-cap stocks are a perennial outperformer. They're a tremendous part of the market. We describe it internally as the sweet spot of the Australian share market, and it's been responsible for some of the names I mentioned before. Those stocks have flourished once they've moved into that mid-cap part of the market. So,
what's the market cap range that you kind of put on that?
That's anywhere between, let's call it $4 billion and probably 25 to 30 bill, something in that sort of range. So 20% goes into Aussie mid caps. I think 10% goes the other end of the market. 10% goes to Aussie emerging companies / micro caps, because that is, I talk about the nursery for some of these businesses. That is absolutely the nursery when the egg is first laid. I mean, we are very early there, and I think that is such an exciting part of the market and lays down the beginnings of what can be multi-baggers over multi-years. So you need 10% in your Aussie microcap. I like Japan, and I think of all the markets that are slightly off-piste, Japan, and I suggest 15% of this theoretical portfolio for 30 years is in Japan.
Wow.
And I think it goes into 3 stocks. I haven't worked out what the 3 are. I've got a bit of an idea. So 3 stocks make you 15%. I think 10% needs to go into, and this will differentiate me from some of that, well, if the portfolio is not already differentiated, I think 10% needs to go into a uranium stock, a copper stock, and a lithium or critical metals stock. So 10%, so that's sort of 3 and a bit % each.
Yeah.
And it might be Cameco, it might be a South American copper hopeful, and it might be Linus or something. So 10% needs to go in a basket of those 3 stocks. And the final one is 5% needs to go into crypto.
Nice.
Crypto is not going away. Crypto, whether we have Harris or Trump in, you can see that the tide has turned on crypto. I think crypto is so important, or is emerging as an important asset class.
Any specific one?
Oh, look, I think as always in markets, you go to the most liquid. So it's Bitcoin and Ethereum would be my stab at it. But as crypto becomes legitimised, more and more regulation progressively gets wrapped around it. We've now got ETFs in the States, so you don't have to buy them directly. You just go and buy the ETF exposure on the US market. I think crypto, I had this conversation with a friend the other day about my children. I get excited about gold and silver, and I'm a bit of a bull on gold and silver prices, and I think it could be part of your portfolio too. But I think the next generation of investors, I don't think that they're remotely interested in buying gold and silver. I think the younger generation, the generation that might comprise part of your audience, they're thinking crypto rather than gold. They're thinking of Ethereum rather than buying some silver. So I think there'll be a role for those metals, but I think the real investment thrust and focus and portfolio relevance lies in crypto. So there's 100% allocation to my theoretical 30-year locked up portfolio.
I love that, yeah.
Why so bullish on Japan of all countries that you could just hone in on? India, like, the Brazil. I'm not going to name all other countries.
No.
But why Japan?
Look, Japan is obviously a hotbed of IT innovation and development. They're leading edge in so many technologies. They do such a great job. They take it seriously. They've got a long track record of high level execution. And by investing in Japan, I know what I'm getting. If I pick an exotic market like Vietnam, it'll probably do well over 30 years. And of course, India, which is well and truly underway now, it's already had a massive run, the whole Indian space. I'm not sure how it plays out over 30 years. I think with Japan, setting aside demographics, I think I know corporately there are businesses there that are extraordinarily valuable and will continue to be huge conduits through to Silicon Valley, for instance, and high tech development is coming out of Japan. So that's why I want to pick 3 stocks. out of the Japan complex that I think will just be such major players in tech and the world going forward. It's a safe place. It's a bit like buying BHP rather than buying something a bit rougher. So it's a sleep at night for my 30-year portfolio.
Makes sense.
But interestingly,
Love
BHP wasn't in the portfolio. Aussie Larger's not in there.
No, it's not. Exactly not. And it's for good reason. I want to see some growth in this 30-year portfolio. I did say I want a copper stock, and you could pick BHP as your one copper stock.
Okay, yeah.
I think you can do better than that. So I wouldn't necessarily run to beat BHP as your copper name. But like I said, but that's up to the investor as to which three they pick. But I just think uranium is going to become more and more critical. Critical minerals and or lithium. The world has now moved to a permanent setting of demand for those commodities, and of course copper. So
Love it.
Well,
thank you for doing that.
That's great. Yeah, a lot to think about.
Yeah.
Just over the past 12 months, with everything happening in markets, what are some of the lessons that you've taken from that period that you think we should all be learning?
Well, I can honestly say, Ren, that probably the most valuable reminder came last September, October, when investor sentiment, animal spirits, call it what you like, was at a real ebb, and people were downcast, and we'd had global central banks hiking rates, stocks going down. I know when we launched our mid-cap fund, people just sort of either closing the door on us or saying, oh, look, it's all awful, it's all going lower. If you looked at the AAI survey, which is a US published survey of investor sentiment, it was printing new lows in terms of investor confidence. Things are pretty down, and the worst thing you thought you could do would be put money in the stock market. It was tough. It was a tough time. Well, sentiment changes quickly, and the old saying, it's darkest before dawn. At that precise point when everyone was hangdog and heads were down low, Jay Powell from the US Federal Reserve came out and gave the market a verbal cut and said, we think we've done what we need to do. Now that catalysed a rally, the like of which we haven't seen in a long time. It was that precise time when you were despairing and giving up was the time to actually buy stocks. So you got to buy when it's darkest before dawn. You need to buy when things are miserable. They say, as Jeff Wilson often says, it's time to buy when there's blood on the streets. It's time to buy. We didn't have blood on the streets, but we certainly had sentiment hung low, very, very low. So I think we learned that. We just saw recently with China. I mean, all hope was lost on China. They're never going to, and then all of a sudden they come out with a series of stimulus packages across a variety of agencies. So I think when it's darkest before dawn, that lesson has never been borne out so clearly as it has in the last 12 months. You know, if you're an investor, if you're an equities investor, you're in for long term. You don't often get setups like we saw last September and just recently for Chinese equities. You don't often get long-term setups like that. When you see it, you need to act.
Yeah.
It's very hard to do, though, sometimes.
Oh, it's tough to do. Nobody says you put a full dollar down. You might put 40 cents of your dollar down, and you need to get started. You need to be true to yourself as an investor. You need to buy setups like that.
Yeah.
So, Ben, if there's one lesson that you could teach every young investor that is listening today, what would that be?
That's in matters of finance, one must be patient. Some of the great gains that are made in stock investing is not, I doubled my money, how good am I, and moving right along. It's staying the course. It is not folding. It's staying with winning positions and letting them run. You must be patient. Otherwise, how do you get a 10-bagger? How do you make 10 times your money on a stock you love and you believe in? You need to resist the temptation to take the profit, which in some cases, some investors' minds should be just not looking every day at the price. That's the magic of your theoretical 30-year portfolio. It will look after itself. It'll compound up. So I think in matters of finance, one must be patient. That belief was born out in reminiscences of a stock operator. If anyone on the podcast has not heard of it or is curious about it, I suggest that you do buy it. And one of the key tenets in that book is the big money in stock investing is not made in the thinking, it's made in the sitting. And that is, there's no truer word has been uttered in the context of share market investing. It's the sitting that makes you the money, not the thinking. So that would be my most ardent advice for investors.
I love that. Yeah. And then on the flip side, I guess, is there any conventional wisdom that we hear in the finance industry that you think is wrong or should be ignored?
Oh, Ren, there's so much. There's so many pieces of conventional wisdom that you're supposed to live and die by that I sort of shake my head when I hear reference to it. And the first one is that day trading is a great way to make a living. Day trading is the only way to go. I mean, day trading is, in most cases, a quick trip to the graveyard. Day trading is not how stocks really, how optimal returns are gained from stocks. To my previous comments, it's all about sitting, not just in and out over a day or two or a week or two. So that's one of the great myths, is day trading is the way to go and make a great living. The other one is that you should set the conventional wisdom is often you should set share price targets. When I double my money on Capricorn Minerals, I'm going to sell them. When they get to $6.50, I'm going to sell them. That is just the dumbest thing to do, because by the time the stock gets to $6.50 and you have doubled your money, the underlying fundamental picture might have got it just a lot better. The gold price might be higher. They might have just bought an asset. So setting target prices, which brokers, not all of them, but a lot of brokers, they're in the habit of encouraging share price targets. It's the silliest thing. Investors should ignore them. Sell high PEs, buy low PEs. That's the convention. Well, that's complete nonsense as well. Some of the greatest returns and the greatest stocks trade on high PEs. And people are, I've got to pay 35 times for this stock when the market multiple 17 times. You know, Breville is not a cheap stock. It's a boring, and I say that lightly, a boring household appliance, household goods, a manufacturer, and it trades on a fulsome P around 30 times, way above the Australian share market on 17 times. But look what it offers you. It gives you great growth. So and buying low PE stocks, because they're cheap, also they're cheap for a reason, because the market has decided they are low growth outcomes. They are businesses that could be of low quality. So we don't take the advice of don't buy high and you must buy low PEs. I think that's a bit of a myth. Sunk capital stories, the other ones I don't like, and that is, here's a gold mine where $500 million has been put into this gold mine over the last 2 decades by 3 owners. All that money's $500 million has got in. It can't be wrong, right? Well, the answer is it will be wrong, because $500 million has gone in and no gold's come out. Yeah. So sunk capital stories often get wheeled out as being exciting, very, very obvious deep value plays, but sunk capital stories are a bit of a misnomer, and they're a trap for investors. And the final one, I love this one, which is the conventional wisdom, is no man ever made themselves poor by taking a profit. Well, the problem is no man ever made themselves rich by selling too early. Essentially, you need to let your stocks run. You're not going to you're not going to maximise your wealth and your value add if you're selling stocks too soon. You need to let them run. And I've mentioned that a few times during the podcast. It's the power of sitting and letting stocks do their thing. So taking a profit's one thing, but you know, if you get off too soon, you're not going to optimise your investment efforts.
This has been an episode jam-packed full of actionable insights, which has been fantastic. And I think from someone with so much experience in the industry, it's been fantastic to hear about it all today. So thank you so much for sharing the time with us and the community today. We really appreciate it.
Thanks, Bryce. Thanks, friend. I've really enjoyed myself. Thanks for having me on.
Now, before we go, we'd like to say a huge thank you to Viola Private Wealth for their continued support of this summer series and for supporting the Equity Mates community. Illiquid investments require both insight and careful planning, and Viola Private Wealth's proven expertise and personalised strategies empower clients to maximise the potential of these assets within their broader portfolio. For more information, head to violaprivatewealth.com.au.
And stick around for our next episode in this series, where we speak to Ricky Bannon of IFM Investors. Ricky's brought some absolute great stock picks to the Equity Mates community. Clarity Pharmaceuticals and Telix Pharmaceuticals over a year ago, both of them certainly stand out. But after that, in the episode after Ricky, we're going to be speaking to Jeff Wilson of Wilson Asset Management. So some big names coming up. Make sure you're subscribed wherever you're listening or watching to this episode, and we'll see you next time.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.